This is an important and time-sensitive update for anyone living in the United Kingdom, particularly those aged 50 and above who have even modest savings in the bank. The news coming out of Revenue and Customs, often referred to simply as HMRC, has sent a ripple of concern through the country. During November of this year, the department will begin a new round of what they are calling bank checks, aimed at people with savings of up to £3,000. The reason is not to punish ordinary savers, but to ensure that the right amount of tax is being paid on the growing level of interest income many people have been receiving over the last couple of years. Yet the move is already prompting anxiety among those who have spent their lives trying to be careful with money. It is only natural to wonder whether your account will be one of those examined, what the checks mean in practice, and whether this signals a broader change in how HMRC treats small savers. To understand why this is happening now, we need to look at the changing financial landscape over the last 2 years. For much of the previous decade, interest rates were incredibly low. Many people earned next to nothing on their savings, and so there was little need for HMRC to pay much attention to the small amounts of interest being paid out by banks and building societies. But as rates have risen sharply since the end of 2022, that picture has changed. Someone who once earned £20 of interest in a year might now be earning £400 or £500, even on a modest balance. It is this increase that has pushed thousands of ordinary people over the threshold, where tax becomes due on their savings interest, sometimes without them realizing it. HMRC's systems are now able to match up interest data supplied by banks directly with individual tax records, and when discrepancies appear, they trigger a check. That check can be as simple as a letter asking for clarification, but it can also mean a review of your tax code or even a request for additional payment if it turns out you owe money. The reason HMRC can now do this with such precision is that banks and building societies are required by law to report the total interest each customer earns every year. This information is sent electronically to HMRC shortly after the end of the tax year, which runs from the 6th of April to the 5th of April the following year. Once the data is received, it is automatically cross-checked with the tax-free allowances available to each taxpayer. If you have gone over those allowances, HMRC can adjust your tax code or issue a letter asking you to confirm details of your income. In the past, small amounts of savings interest may have gone unnoticed, but now that the sums involved are rising, the department is tightening its oversight. For people aged 50 and above, this is particularly significant because many rely on savings as a buffer or as part of their retirement planning. You may have spent years setting aside small sums, perhaps from redundancy money, an inheritance, or simply careful budgeting. It is completely reasonable to assume that a balance of £3,000 would not attract HMRC's attention. After all, this is not a fortune. It is an amount that, for many, simply provides peace of mind. However, the key issue is not how much you have saved, but how much interest that money earns, and how that interest interacts with your tax band. For instance, if you are a basic rate taxpayer, you can earn up to £1,000 of savings interest each year before you need to pay any tax on it. For higher rate taxpayers, the allowance is only £500. If you happen to earn more than these amounts, HMRC will want to collect tax on the excess, even if the difference seems small. Let's take a realistic example. Imagine you have £3,000 sitting in a fixed-term savings account paying a rate of 5%. That means you earn £150 of interest each year. On its own, that is unlikely to trigger a tax bill, but if you have 2 or 3 other small accounts, perhaps one joint account with your spouse and another older account, you forgot about the total could easily reach £800 or £900 in interest. Add in a small premium bond prize or a building society loyalty bonus, and you could find yourself over the limit without realizing it. That is why HMRC's new checks are focusing on people with multiple small accounts, or those whose interest income has increased compared to previous years. Another reason for the checks is that some people have moved money around in search of better rates. Over the last 18 months, banks have been competing fiercely for savers, offering short-term deals or special rates for new customers. When money moves between accounts, the reporting process can get complicated, and HMRC's automated systems may flag discrepancies. For instance, if you close one account in March and open a new one in April, the interest might be split across 2 tax years, leading to confusion. HMRC has said that many of the letters being sent this November are not accusations of wrongdoing, but requests for clarification, giving taxpayers the chance to confirm or correct information before a formal tax adjustment is made. Nevertheless, for many people, receiving an official letter can be worrying. There is another side to this story that is worth noting. While the focus has been on those with savings up to £3,000, the checks are part of a wider digital transformation at HMRC. The department has invested heavily in new technology that allows it to track income from multiple sources, including banks, pension providers, and investment platforms. These systems can automatically cross-reference data against what has been declared on tax returns or through the PAYE system. The aim, according to officials, is to make tax collection fairer and more accurate. But critics argue that it risks causing unnecessary stress for those who are doing their best to comply but simply do not understand how the new rules work. Many older taxpayers feel uneasy about digital letters and online portals, preferring the reassurance of speaking to someone directly. Yet with HMRC encouraging more people to manage their accounts online, that traditional personal contact is becoming harder to access. So, what should you do if you are in this position? The first step is to gather information. You can check how much interest you have earned by looking at your annual savings statements or logging into your online banking account. Each bank must show the total interest paid before tax. Add up the figures from all your accounts, including joint accounts, to find the total interest for the year ending the 5th of April. Once you have that number, compare it to your personal savings allowance. If you are below £1,000 as a basic rate taxpayer, you will not owe any tax on that interest. If you are above it, you will need to pay tax on the difference. For most people, this will not mean filling in a tax return. HMRC usually adjusts your tax code to collect the extra amount automatically through your pension or salary. But if you are retired and only receive pension income, you should still notify HMRC of your interest earnings to ensure your code is correct. It is also worth thinking about how to make your savings more tax efficient. One option is to use an individual savings account, or ISA, where all interest earned is completely tax-free. You can deposit up to £20,000 into ISAs each tax year, and any interest or investment growth within the account does not count towards your savings allowance. For those with small savings, even transferring part of your money into a cash ISA can provide peace of mind that no future tax will be due. Another approach is to keep an eye on interest rate movements and consolidate accounts to simplify your finances. Having fewer accounts means fewer statements and less chance of missing something when HMRC checks your records. The key message from financial advisors is not to panic, but to prepare. A bank check from HMRC does not mean you are in trouble. It simply means your account has been selected for review based on the data available. Responding promptly to any correspondence and keeping accurate records will prevent small issues from turning into larger ones. If you are unsure how to handle a query or letter, you can contact HMRC directly or seek help from a qualified tax advisor. Many local citizens' advice offices also offer free guidance for those dealing with tax concerns. What you should not do is ignore a letter or assume it will go away. Once HMRC has flagged an account, it will expect a response, and failure to reply could result in penalties or automatic tax adjustments. Beyond the technical details, there is an emotional side to this story that cannot be overlooked. For many people aged 50 and above, savings represent security and independence. They are the product of a lifetime of careful management, sometimes built up from modest wages and sacrifices. To feel as though those savings are under scrutiny can feel intrusive or even unfair. It is important to remember, however, that HMRC is not targeting savers for the sake of it. It is enforcing existing rules that have always applied, even if they were not widely noticed when interest rates were lower. The change is not in the law, but in the circumstances. Higher interest rates and more powerful data systems have simply made it easier and more necessary for HMRC to ensure fairness across the system. The month of November has been chosen for these checks because it coincides with the period when banks finalize and transmit their mid-year interest data. Officials want to ensure that by the end of the tax year, adjustments can be made smoothly. This means letters and tax code updates could begin arriving any time between the 1st and the 30th of November. If you receive one, take a deep breath, read it carefully, and remember that you have time to respond. The letter will outline what information HMRC believes it has received and invite you to confirm or correct it. Often, a simple phone call or online confirmation resolves the matter within minutes. The broader takeaway is that financial awareness has never been more important. Even small sums can have implications once interest rates rise. The difference between being informed and being caught off guard can be the difference between calm and anxiety. Those who review their accounts regularly, understand their allowances, and keep documentation at hand will find this process much easier. As people approach or enter retirement, it becomes especially vital to stay organized. It is not just about avoiding unexpected tax, it is about ensuring that your financial plans remain stable and predictable. This situation also raises wider questions about trust in the tax system and the balance between efficiency and empathy. Many older citizens remember when tax affairs were handled by local offices and you could speak to a familiar advisor face to face. Today, automation and digital communication dominate, and while they make systems faster, they can also feel impersonal. HMRC insists that its goal is not to intimidate, but to ensure fairness and consistency. Yet the experience for many can still be unsettling. By being proactive, checking statements, keeping written notes of conversations, and making sure you understand your tax code, you can maintain control and confidence. As we move through November and beyond, more updates are expected. If interest rates remain high into next year, similar checks are likely to continue. There is even speculation among financial journalists that the £3,000 threshold may be reviewed in future to reflect inflation and savings trends. For now, though, the most practical step is simply awareness. Knowing where you stand removes uncertainty, and clarity is the best defense against financial worry. If you value staying informed and appreciate updates that cut through confusion with straightforward explanations, please take a moment to like this video and subscribe to the channel. Doing so helps us continue providing timely, reliable information about changes that affect everyday people in the United Kingdom. Whether it's tax, pensions, or the rising cost of living, understanding these issues is the first step towards staying in control of your future. Financial peace of mind is not just about numbers, it's about confidence, dignity, and the comfort of knowing that you are prepared for whatever comes next.